Hello, my name is Neil Billyard. I'm the Head of Tax here at BDO. Welcome to our 2024 Federal Budget webinar. Those of you that are old enough will remember nearly 25 years ago in June 1999, the government of the time introduced the legislation that brought in GST. A year later, that came into operation, and I would say that's probably the last meaningful tax reform we've had in this country, so 25 years ago. Every year, we hope that every government will do something more and be bold and be brave, but we just see more tinkering around the edges. We've got a panel of experts from BDO from around the country that will go through Tuesday night's budget, and we'll talk about what's in it. Unfortunately, I think you'll realise that we're seeing some more tinkering around the edges rather than bold, meaningful tax reform. I'd like to begin by acknowledging the traditional owners of the land on which we work, which here in Sydney are the Gadigal people of the Aurora Nation, and pay our respects to elders past and present. We extend that respect to Aboriginal and Torres Islanders people joining us online today. Just some housekeeping. You'll see on your screen there's an opportunity to provide questions. Please click on that tab and do so. We have received a number of questions beforehand, and the speakers will try and deal with those questions during their presentations. If they don't, there's a little bit of time at the end where they can address some specific questions, either the pre-submitted ones or the ones that come through during the session. And then in terms of after the session, you will get an email that will provide copies of the slides, recording, our contact details, and some more materials on the budget. Hopefully you won't have technical problems. The fact that you're listening to me means that you've been able to get on, but if something props up and there's a problem during the broadcast, there is that support button as well. I'll now introduce our panel of speakers. As I said, these are specialist BDO partners from around the country, each specialist in their own areas. I'll introduce all of them now, and then we can sort of run a bit more smoothly once the presentations get underway. Firstly, Anders Magnusson leads the BDO economic team and regularly comments on macroeconomic movements in the national media. He is a purpose-driven economist who helps his clients achieve social benefit by leveraging the breadth and depth of expertise at BDO. Secondly, Denise Brotherton will talk. Denise is a Melbourne tax partner with over 20 years experience in the field, with particular expertise in manufacturing, private equity, life sciences, and agribusiness. Denise will be followed by James Trainor, who is a tax partner in Sydney, who also has over 20 years experience providing employment tax services to a range of public, private, and non-for-profit clients. And then lastly, Shirley Schaefer leads our superannuation team from South Australia. Her passion for all things super is well known, and judging from the questions we have received, she's probably not the only one that has that passion at the moment. Shirley has been working in the super space for over 25 years and is an expert in all things SMSF. I'll now hand over to Anders to take us through the economic aspects of the budget. Thank you.
Well, thank you very much, Neil, and good morning, everyone. This budget is exciting for economists, not just because it's a budget and every budget is exciting for us, but because I think the government is being quite innovative here. But is that innovation good economic policy or just politics? Like any good economist, I'm incapable of giving you a straight answer to any question, so my answer is it's a bit of both. But I'll try to shed some light on that and give you my view as I take you through the economics of this budget. So let's start with the economic outlook. Global growth is uncertain. We've seen from the government's commentary on the economic outlook that the main concerns are weak growth in China, and also supply chain disruptions because of ongoing conflicts, particularly in the Ukraine, and risk associated with other conflicts around the world also. Real GDP growth is forecast to be just 1.75% in the current year, and looking ahead 2 years, still only just over 2%, and that is historically low. Unemployment is expected to increase to about 2.5% in the next financial year. While that is increasing, it is still also historically low, and that is a good thing for workers, being a tight labour market, but it will present challenges to some of the aspirations that the government has laid out in the budget, because we need people to work on a lot of those things. As a consequence of that tight labour market, real wages growth has returned and is expected to continue, but that growth is also relatively slow, and there is a risk there that if inflation doesn't come down as quickly as we might hope, that real wages might continue to stagnate. Looking at the budget balance, the government has made a lot of noise about the expected surplus in the current year's budget, as well as last year, about two surpluses in a row, and that is the first time that has happened in quite a long time. And they ought to make a lot of noise about that, because they're not expecting another surplus as far as the forecasts go. So why did we have these surpluses? Largely, it's due to the unexpectedly high commodity prices that we've been receiving for the things that Australia sells to the rest of the world, and the revenues to government associated with that. Those prices are expected to be lower in future, as well as the increasing spending pressures from interest costs, the NDIS, defence, health and aged care. For all these reasons, we're expecting kind of ongoing deficits after this year. And then inflation. So the government is expecting inflation to reduce to 3% by the end of this year. That's significant, because once inflation reduces to that amount, that's when we should expect in normal times for the Reserve Bank to begin reducing the cash rate, and things would get a bit easier for Australians. But that's a complicated story that I'll return to. So my view on the outlook for Australia's economy: slow and steady growth, constrained by weak global demand, and in particular scarce labour and housing. So let's move to talk about cost of living. After all, this is really the central focus of the budget, and it's what the government has really focused on with all of their messaging. Firstly, I'll talk about power bill relief. So the government is going to pay $300 per year for every household's power bills to subsidise their power bills. This, of course, is directly beneficial for cost of living. You give someone $300 and the $300 better off. But then what do they do with that $300? Right now, when people are struggling to get by, people will spend that $300 into the economy on other things. And so while inflation, as measured by the government, is expected to decrease because people will be paying less on their power bills, when people then spend that money back into the economy, we can expect inflation to occur because of that increase in demand. So from this, we can expect that inflation will come down in the near term and towards the end of this year, but we can also expect the RBA to be quite hesitant about responding to that with a cash rate cut, because it will be taking a wait and watch approach to see if the respending of that money into the economy leads to more inflationary pressure, perhaps in the start of next year. So we could be in an interesting situation at the end of this year, where the Reserve Bank is hesitant to reduce the cash rate, but the Australian government might stand up for the Australian people and put pressure on the Reserve Bank to take their cue from inflation and reduce the cash rate. That will be a very polite, very public, interesting argument to watch. So my view on the power bill relief, that's good for cost of living right now, but bad for inflation. One more thing to note about the power bill relief is that this is paid to every single household in Australia. In the previous budget, a similar policy subsidised the power bills for just lower income households, but this time it is every household. And not every household in Australia, I imagine, needs $300 right now. So I'm left a little confused as to why every household is receiving this payment. After all, I don't think $300 is really enough to buy votes from high income households either, if that is the intention. So moving on, the government is also providing support for renters. They are increasing the maximum rate for Commonwealth rent assistance by 10%. Housing is persistently a cost of living challenge for Australians, and particularly in the last few years, the increasing housing costs has contributed to inflation quite substantially and continues to. Commonwealth rent assistance is paid to people who are generally on lower incomes. So this policy, in my view, provides the right type of support to the right people, which contrasts, in my view, to the power bill relief. Next is stage 3 tax cuts. This is probably the most significant cost of living change that will come through in this budget. On average, taxpayers will be about $1,900 per year better off because of this. That is a lot of money, especially comparing it to the $300 that I've already spoken about and my concern for inflation about from the power bill relief. The difference is that everyone knows this is coming, including the Reserve Bank, and so the inflationary effect of this has already been taken into account with the current cash rate setting of the Reserve Bank. So my view on this now is that it's inflationary, but that's old news. The government is also rolling out a raft of other cost of living measures that I won't go into in detail, but these are targeted at students, older people, women, parents, and carers. Measures such as tweaking the HEX indexation, paying superannuation through parental leave, and improving the pharmaceutical benefit scheme. These policies tend to be focusing on an appropriate type of cost and paid to an appropriate group of people who need support in those areas. So in general, my view there is that these are a good targeted policy. But you will hear more about the effects of these from my colleagues a little later and the implications for individuals. Future Made in Australia. Now this is a central philosophical piece in this budget. I say that because it's not that big dollar-wise. I mean, it is billions of dollars, but relative to some of the other budget measures and relative to how much airtime the government has given this leading up to the budget, I would say that it's more of a philosophical piece that charts a course for Australia and gets people thinking about our role in the future economy. Now, economists, including myself, were skeptical about this policy leading up to the budget. We were concerned that this would be the government investing a lot of taxpayer money into projects which may turn out to be poor investments, or what we call in economics picking winners. What we've seen in the budget is that most of the funding is allocated to production tax incentives for renewable hydrogen and value-added critical minerals. What that means is that businesses in future that are producing either of these things will pay less tax than businesses producing other products. And that improves the commercial proposition for businesses to undertake those projects, to invest in production of these things. And what the government's done here, it's not just hydrogen and critical minerals they are incentivizing. They're specifically looking at renewable hydrogen, so investments in the capability to produce hydrogen from renewable energy, as well as value-added critical minerals. So not just digging things out of the ground and selling them overseas, but bringing more of that supply chain back into Australia and capturing more of the value adding along the supply chain here. There's also funding for other areas, but it's a little less well defined how that will happen. So the devil will be in the detail there. And that is incentivizing production of green metals, low carbon fuels, batteries and solar panels. Now, back to picking winners. I was comforted to see that the government is not just dropping big bags of money on specific projects here, but they want to implement what they're calling a national interest framework. And that's a framework that the government will use to select what products and industries they want to incentivize as part of this policy. Critical to all of this is skilled labor through the investment phase. We don't just need money, and funding and incentives to achieve these projects. We need people with tools in their hands on the ground to build these capabilities. And the government has included some investment in those areas as part of this as well. So my view on Future Made in Australia, it will likely be good for Australia's economy in future, but difficult in the investment phase. So moving on to housing. Housing is a real constraint on economic growth in Australia right now, and it's a persistent social issue. We've all heard stories about businesses who finally were able to find a worker to fill the vacancy that they have, but that worker was unable to start because they cannot find a place to live. I've been hearing that story a lot from regional Australia, but I think it's a good metaphor for the Australian economy right now as well. And we're seeing restrictions in migration because Australia is worried about where these people are going to live. But as I've just discussed, we do need this labour. We do need these skills to achieve the projects that we've set for ourselves. So the government is doing some things in this budget to help address this. The Commonwealth Rent Assistance increase, which I've already discussed, allocation of funding to housing, social housing, student accommodation, and also allocations to state governments that are doing housing initiatives as well. Just like Future Made in Australia, we need people to build these houses. We need labour and skills on the ground to do this, and the government has recognised this and is doing something towards this in the budget as well. Firstly, increasing the number of fee-free TAFE places relevant to the construction sector, and also streamlining skills assessments for some migrants. Migration is an important source of labour that could help here, because yes, migrants need somewhere to live, but a lot of them are really good at building houses too. And streamlining the skills assessment will make the new arrivals much productive much more quickly in terms of the construction sector. So my view on these housing measures, we need more investment in labour and skills, more than we've seen so far in this budget. And I'd like to end on my pet budget issue, which I'm betting most of you have forgotten about, because this was raised by Jim Chalmers in his first budget speech, Measuring What Matters. So in that speech, and in a lot of speeches that Jim Chalmers made around that time, he was questioning whether GDP is really what matters, and if that's the kind of metric that we should be using to evaluate public sector initiatives, and suggested that perhaps we should be looking much more broadly at a range of indicators that, that correlate with the well-being of Australians. So in that first budget, there was an allocation that kicked off a research and consultation process that has now completed, and we do have a framework called Measuring What Matters, which is a set of indicators that that can be used to understand Australia's progress on well-being. In this budget, if you read closely enough, you will find that there's an allocation to the Australian Bureau of Statistics to modify their general social survey, an existing survey, to collect all the data that's needed to form a baseline by this framework. Now that is a monitoring action, not a decision action. And to quote Treasury directly, we're looking for opportunities to embed this framework into government decision making. So there's been a little bit of progress here towards monitoring and forming a baseline, but in my view, we need more action towards a decision-making framework. That's my economic view. I'll pass you over to Denise now to give you the perspective for corporate Australia.
Oh, good morning, and thanks so much, Anders, for a really concise economic overview. Now, I'm going to be the first of 3 colleagues in total that are going to deal with the tax outcomes from the budget. And I'm going to start off by espousing a quote from Benjamin Franklin, as he famously said, "In this world, nothing can be said to be certain except death and taxes." And this phrase applies so equally, irrespective of whether you're an individual or a corporate or a business entity. So my segment of the webinar today, as I deal with some of the tax changes as they impact corporates and businesses, I promise you that this session, whilst it will deal with taxes, it won't be death by PowerPoint and me going through loads of technical analysis. However, over the next 5 minutes, I'm going to provide you with the key tax facts and stats in relation to what the budget means for Australian corporate entities and businesses who, although they aren't voters per se, are important contributors to Australia's tax revenue collections. And then, of course, if there's anything in the presentation today that you want to do a deeper dive into, then of course you can refer to BDO's detailed federal budget report that you will have received by email. So first of all, just an outline now of some of these tax changes for corporate. So I'm going to start with what I call that old chestnut. So that small business instant asset write-off that's been around for a number of years. Now it gets another extended life out to 30 June 2025, which enables businesses with an aggregated annual turnover of less than 10 million to be able to write off immediately assets that they acquire that are less than $20,000 in value. And then from the 1st of July 2025, it goes back to the $1,000 threshold. The second announcement that I wanted to run through deals with how we're taxing some of the foreign residents that own property in Australia. So there's a few measures that were announced. The first one will sort of clarify and broaden the types of property assets on which foreign residents are going to be subject to CGT. And this has been expanded to make sure that we're covering off those that are property assets that are both directly and indirectly owned by foreign residents, and those that what we call have a close economic connection to Australian land. So if we think broadly on what this could cover, it could include water rights, pastoral leases, potentially mobile towers and renewable energy assets that are affixed to land. So it will be interesting to see how this part of the budget announcement expands, but it certainly goes to try and address some of these key issues that have been raised over this period of time in trying to define what property assets are. There's also going to be an anti-avoidance measure that will change the current point-in-time principal asset test to actually a 365-day test holding period to determine whether or not the property was owned by a non-resident during that point of time. So that's sort of, as I said, an anti-avoidance measure, stopping a foreign resident from changing ownership just before a point in time and actually looking at the 12-month period beforehand. We're also introducing a self-assessment and reporting requirement that will require foreign residents disposing of shares and other membership interests that exceed $20 million in value to notify the Australian Taxation Office prior to the transaction being executed. This is going to be an interesting development because there's certainly some concerns at the moment in terms of whether or not this self-reporting system and the requirement to have the tax office sign off on this could actually see a delay in settlement of transactions. Thirdly, a while back there was a previously announced intangibles integrity measure, and that proposed to deny a tax deduction for certain payments for the use of intangibles out of Australia where those intangibles are actually used in low tax jurisdictions. Now, the government has done a bit of a backflip on this, and it's not because they don't consider it an important matter. It's more that they've decided that because of our new global minimum tax and domestic minimum tax regimes, that this type of payment should be covered within that new tax regime. And I'll touch on what that is a little bit more shortly. Next, there's going to be some more penalties introduced that are going to apply to large multinational groups that have aggregated annual turnover of more than $1 billion Australian dollars, where they've found to either have miscategorised or undervalued royalty payments that they make. Now, this is going to a withholding tax anti-avoidance measure. And from my perspective, this announcement was not unexpected, given the taxation of intangible assets has continued to be a focus area for the government and the ATO for some period of time. Next, another anti-avoidance measure, and it goes to that first point, and this is a matter of including schemes that go to reduce the payment of withholding tax in Australia on income paid to foreign residents, and also includes situations where you are looking to achieve an Australian income tax benefit, even though the dominant purpose of the arrangement was to actually reduce a foreign income tax obligation. And I have actually seen this example from a practical perspective. So again, an extension of our current general anti-avoidance rules. The start date for these rules will be the date of royal assent, but it will apply to any transactions entered into before or after that date of royal assent. And finally, Anders mentioned the government's proposal to accelerate the investment in what we've termed the Future Made in Australia priority industries. And the budget has announced the introduction of 2 production tax incentives. And the first one is what we've termed the critical minerals production tax incentive. And that's proposed to be 10% of relevant processing and refining costs for Australia's 31 critical minerals. And this incentive will be applicable for projects with up to a 10-year lifespan. The second production tax is a hydrogen production tax incentive, and this is proposed to be a $2 incentive per kilogram of renewable hydrogen that's produced. And again, it's over a 10-year project life. So interestingly, The opposition has already stated that they're going to potentially oppose these tax incentives on the basis that they're going to make the billionaire mineral business owners even richer. As Anders mentioned, those companies that will be eligible for this tax incentive will pay less tax. But of course, this is about an incentive to encourage them to actually produce some of these sort of really critical priority industries that the government has identified. It'll also be interesting to see how these tax incentives will also interplay with our new global and domestic minimum tax regimes if the inclusion of these incentives for these big groups actually has the impact of reducing an entity's effective and minimum tax rate to something less than 15%. So very much wait and see, and certainly there's been lots of discussion in the media around these incentives. The next thing is just a bit of an update on the progress of some of the tax reforms for what I'll call the big end of town. And if I summarise it, it is more compliance and more reporting. And just a couple of the ones that I wanted to touch on were there's a new global minimum and domestic tax regime. So this is really about stopping significant global groups from putting businesses into low tax, no tax jurisdictions to try and take advantage of very low effective tax rates. Now, for Australian entities that are subject to this new regime, it applies from the 1st of January 2024. If you're starting with a 1 January year end. But interestingly, the legislation is still going through the consultation process. So a situation where we're in the tax regime, we're still waiting for legislation to give us the guidance around it. The government at the moment is not expecting significant tax revenues to be raised from the implementation of this new regime, but certainly it's placing a big compliance burden on those companies that are subject to the compliance reporting. Our new thin capitalisation regime, that's a limitation on interest deductions, has now moved to an earnings-based approach as opposed to a debt to asset approach that we previously had. And that's in line with a lot of the other countries that we're seeing in the OECD fold as well. Those final rules have now all been enacted, and that regime applies from the 1st of July 2023. The other part is, and I'd already touched on the denial of deductions for payments for intangibles offshore. As I mentioned before, that has been shelved, it's effectively discontinued. But what it has in part been replaced with is a new penalty regime where you might be miscategorising or undervaluing some of those royalty payments, and there's a royalty withholding tax avoidance there. So they were announced, or this regime was announced in the budget on Tuesday night with an expected implementation date of the 1st of July 2026. So the last part that I wanted to touch on was, of course, lots of new compliance and reporting requirements, new tax regimes as well. And so the government has given the tax office some more funding to make sure that they can undertake the enforcement and compliance activities that we need to have in place to make sure, as we call it, everybody's paying their fair share of tax. So if I reflect now on the budget announcements that I've just highlighted, there's probably 3 key themes for corporates and businesses, and that is compliance and reporting, and there continues to be more compliance and reporting obligations imposed on companies and businesses, whilst many of them continue to have to deal with resourcing and productivity constraints So it's a little bit about what I call being asked to do more, but often with less. The second part is the tax incentives and making Australia globally competitive in some of these sort of future key industries. And so, again, as I mentioned, it'll be really interesting to see what plays out in the media as we talk more about the incentives that are going to be given or focused on some of these key industries. And then finally, as I mentioned, it's all around enforcement, the government providing more funding for the ATO as they expand their activities in monitoring tax compliance and making sure that everybody does pay their fair share of tax. Now, I've dealt with the corporate and business side of it, so I'm going to pass over to James because he's got the really interesting part. It's what I call what's in it for me. Thanks, James.
Thanks, Denise, and hopefully we will find some things that are in it for you as we talk about the impact of the federal budget on individuals. Well, good morning, everyone, and thank you so much for joining us and taking time out of the day to sit with us and hear about how the budget might impact you, both as a corporate or as an individual. But before I dive in, I really need to let you know that I am terribly disappointed, terribly upset with the Federal Treasurer. Why? Well, when I was a grad, more than a couple of years ago, we would line up for hours outside of the government printing office, and then we'd collect the physical copies of the budget papers and we'd race back to the office and we'd pore over those budget papers to uncover the new and exciting tax measures that had been announced on that night and were probably going to be implemented in the coming days. It was just like unwrapping presents on Christmas morning. But as I tuned into the budget on Tuesday night and at 7:31 downloaded the budget papers and I pored over the papers, I was really disappointed. I wasn't excited. There really wasn't much new in the budget papers. And so the Treasurer has taken all of the fun out of budget night by revealing most of the measures in the days or even the months leading up to the federal budget. So it doesn't make budget night as exciting as what I used to remember as a child. So that's disappointing. But it does mean that there was a little bit more time that we had to consider the measures that were introduced or announced before budget night and have a think about how they might impact individuals. And also being mindful that many people on this call will be business owners or managers. Also think about what that means for your business as an employer. So if we think about the three key principles that the budget covers, and a lot of these things were spoken about by Anders, and so you will see some similarities between what Anders was talking about and what I'm going to talk about. And that was because this budget was focused on cost of living. That was one of the key planks that the government spoke about. And cost of living really is something that impacts individuals. So we need to make sure, the government needs to make sure that the measures it's introducing are targeted at individuals. So it'll be a little bit of repetition in terms of some of the key measures, but we'll have to think about what it actually means for you and your hip pocket. So the three basic principles were cost of living relief. The second is cost of living in relation to inflation. And Anders has already challenged the idea that these measures will actually result in downward pressure on inflation, but nevertheless, we'll group those together as principles that were taken to the budget by the government. And the final principle is the future made in Australia. And we'll have a little bit of a discussion around what that means, mostly for employers in this space. So turning now to the cost of living relief. There were three main planks in the cost of living relief. The income tax rates. Now, these are the stage 3, or is it stage 3.1 or 3.2 tax cuts? It's hard to keep up. There were significant changes from when these were actually written into law. They were in legislation, but they changed, they morphed over time. And the reason the government gave for wanting to make these changes is to target the income tax cuts at a broader group of taxpayers, or voters, taxpayers, both voters. So it's opening up to those lower and middle income earners and not giving the lion's share of the savings to the higher income earners. And so what it does, these changes, it changes some of the tax rates, so bring the tax rates down, as well as change some of the tax rate thresholds, so the levels of income at which each of those rates apply. Now, for those earning about $50,000, it's about $1,000 worth of tax savings, and it caps out for those who earn $190,000 or more of taxable income, and the maximum saving will be $4,529 for those individuals. Now, these savings will flow straight from the 1st of July because there will be changes to the tax withholding rates. So salary and wage earners will see more money in their pocket every week or monthly pay period from the 1st of July. So that's real cost of living relief directly impacting individuals in a real sense. But need to be careful here because the income tax thresholds still aren't indexed. So as real wages increase over the coming years, we will see more taxpayers move into higher tax brackets, and so the tax savings and the tax cuts that are available this year will be eroded as people move through the tax brackets and their income increases over time. And that's something that's always a problem with Australian income tax rates and the way our system works for individuals. We've seen that addressed a little bit with the Medicare levy threshold. So this is the threshold at which individuals have to pay the Medicare levy. And the government is, for the second year in a row, indexing the threshold. So for singles, it increases from $24,000 to $26,000, and for families, it's about a $3,000 increase to $43,000. So until you earn that amount of taxable income, you don't have to pay the Medicare levy. It also increases a little bit depending on the number of dependents you have as well. So again, for people at lower income levels, it will actually deliver real tax savings from the 1st of July. Finally, student debt relief. And so this is the third pillar. So I've got income tax rates for people who are in the, workers in the system, the Medicare levy threshold changes for people at lower income levels, and students. So the third big category of taxpayers that the government needs to keep happy. And this is a retrospective change to the indexation rate that is used to increase the debt that students incur from their tertiary studies. And what's happening here is that there was a spike in CPI rate at the back end of COVID, and that resulted in an indexation rate of in excess of 7% for that student debt. And the government has now stepped in and says that the indexation rate will be capped at the lower of the CPI rate or the wage price index. And the wage price index for the period, the last financial year, was actually 3.2%, so a much lower rate. So what that means is that students will see about $1,200 wiped off their debt. And with a father of 2 kids that have been through university, they're happy about the fact that their student debt is not increasing as much as what it was going to prior to this change. But there's still a problem with the way that the government manages HELP and HECS debts. And that is that the amounts that every one of these students pay each week by their salary, by having additional tax withheld, goes to the government, but it's not used to offset the debt immediately. It only happens at the end of the financial year after indexation is applied. So it's still a little bit unfair, the system. So I think the government can do more to help students manage their debt. Now, if we look at the second principle, and that's cost of living measures that will target inflation. And so Anders has already touched on these points around energy, rent, medicine, and groceries. And all of these measures are part of the government's aim to actually put downward pressure on inflation. But as Anders mentioned, that might not be the case. And I guess the point around the $300 rebate and Anders' question as to why does everyone get it when everyone doesn't need it? Well, the problem here for the government is that it's, in the grand scheme of things, it's not a big amount. And the cost to government of trying to deliver this outside of the energy providers and deliver it direct to taxpayers and figure out who's got an energy bill, what their taxable income is, that all just costs too much, and you could quickly exceed $300 that you're trying to give to each of the households who have energy bills. Point to note here, all of these sorts of things are the real expenses that individuals incur every day. And if we just touch on groceries for a minute, that's nothing in terms of dollars today into people's pockets, But certainly the government is looking to target supermarkets, the large supermarkets out there, with a range of inquiries and reports, really targeting competition and pricing and trying to put the blowtorch to those large supermarkets to actually drive down the cost of groceries, which is obviously a really big part of everyone's daily budget. Turning now to the future made in Australia. Now, this is grand plans. It is long-term. And so what does this mean for individuals, and what does it mean for employers as well? So what we will see coming off the back of this is that there will be an increase in employment opportunities in those priority industries that the government is targeting and funding. So the government's actually providing education to help support the movement of workers or the skilling of workers into those areas. And so there's money for TAFE places, there's money for education at tertiary levels to help people become skilled in these new industries. And there's a particular focus on both Indigenous workers and women to bring them into a high level of skills so they can actually provide the labour that's needed to see these industries grow over time. And for individuals, what this means is that over the long term, to the extent that there is growth, to the extent that there is lower unemployment, all of these things are helpful for the government in that it gives the government more money. And with that more money, it is then able to turn around and offer tax cuts to individuals in the long term. So we really need, as individuals, to be thinking about these grand plans and what it might mean for us, and particularly as employers as well, because obviously as workers move into these industries, if you're competing for them, those workers, and you're not in one of those priority industries, then you need to think about, well, what are the incentives that you're going to provide? Do you need to pay higher wages, or think about other incentives to get those workers to come and work for you? Targeted migration as well is part of that. So the government announced that there would be a cap of about 185,000 new permanent residency places in the coming year, and most of those, about 130,000 of those places, are migrants with the skills that Australia needs. So it is targeted migration is again where we're going to see the labour come to support the Future Made in Australia plans that the government has. There were a number of other measures that were announced in the budget which are going to impact individuals. Like corporates, the ATO is going to get more funding for its personal income tax compliance program, and governments typically have had a really good return by giving more money to the ATO as they go out and actually recover more in tax from taxpayers. So we'll see that extended out another year. And has touched on some of the housing, additional funding with a particular focus on social and affordable housing. For students, there's more money for students who are undertaking vocational training. So whilst they're in internships and placements, that'll be some money, some payments to them on a weekly basis. And also there's been some money set aside for victims of domestic violence to help with financial support as people move out of those violent situations, and help them with a range of support services to get themselves back on their feet into better situations. So while not necessarily a lot of new and exciting material, and indeed even some uncertainty around whether those measures will actually achieve their targets, if they are successful, hopefully we will see the cost of living pressures eased for most individuals, and it'll see more cash coming into your pocket. Now, what can you do with that cash? Well, you could buy the Powerball ticket tonight, or perhaps you might want to think about saving for retirement. And with that unplanned segue, let me hand over to Shirley to talk about all things superannuation. Over to you, Shirley.
Thanks, James, and welcome everyone to the last section for our presentation for you this morning. There wasn't much in the budget for super, so I want to start by asking you a question. Could you retire tomorrow? Do you have enough in to enjoy your retirement, or are you going to have to limit your activities in retirement? The Association of Superannuation Funds of Australia publish a retirement standard each year, and they've identified that for couples to have a comfortable lifestyle, they're going to need $72,000 per annum or more each year, and for singles, $51,000. So that's a fairly hefty whack. So building your super, of course, will help achieve those retirement goals. And we don't want to rely on the age pension. Well, I don't anyway. So is there anything in the budget that can help us do that? Even the smallest things can get us there. So let's explore what the Treasurer said. And as I said, it wasn't a great deal. So we'll look at the budget announcements. I want to focus on a few measures to help grow your super. And while I didn't want to be very negative today, I can't help but talk about the new $3 million threshold tax, and we'll get to that. So the only real positive announcement in the budget was the introduction of basically payment of superannuation guarantee on paid government-funded parental leave payments from the 1st of July 2025. Certainly a good move, and was pressured by the Greens to get this in as part of their deal to help get the $3 million tax measure through potentially at some later stage. Superannuation was mentioned 14 times in the budget papers. I always do a search on the document to see how much work I have to do. But the rest of the measures are really around protection of super, increased funding for the ATO to combat fraud for tax and super, introduction of payday super to help support that. I'll come back to that shortly. They're going to increase the pursuit of unpaid super entitlements when companies or employers go into liquidation or bankruptcy. All good measures. And then, of course, they're going to give themselves some money so they can work out how this new better targeted super concessions, the $3 million threshold, is actually going to apply to their own Commonwealth Government defined benefit superannuation interests. I'm not sure why they introduced a measure that they didn't know how would work on themselves, but there you go. So, increasing your superannuation benefits, where can we start? The one thing I remember from university that one of my lecturers said, and it was a long time ago, so I don't remember much, but the beauty of compound interest means that the small amounts that we put in now will grow to be bigger amounts into the future. And a lot of these things are about that compound interest growth. So payday super will be introduced from the 1st of July 2026. This means that employers are going to have to make payments of your superannuation contributions on the same day that you get your salary or wages paid into your bank account. Obviously, that also will help combat unpaid super debts and obviously allow it to grow sooner. Last year, the announcements or the changes were that we get superannuation from $1 of wages. We no longer have the threshold of $450 a month. Anyone earning below that wasn't getting superannuation. We now get superannuation from $1. And then lastly, something that perhaps we should all take a little bit of time to do is go and do a search. Do you have unclaimed super that will enable you to further compound or grow your superannuation balances? You don't want to leave it hiding in the bottom drawer or at the ATO. You will need to put it to work for you for your retirement. The other thing that will help grow your super at the moment is our contribution limits are changing from 1 July 2024. And there are some slight errors still in that slide, sorry. All of the dates are 1 July 24, I do apologise for that. So our concessional contributions go up by $2,500 up to $30,000 per annum. Concessional contributions include your employer contributions, your super guarantee, salary sacrifice, and of course personal concessional contributions where you're claiming a deduction for the contribution yourself. As a consequence, non-concessional contributions will also go up to $120,000 per annum from 1 July 24, and the 3-year bring forward rule goes up to $360. So certainly we've seen, this is the first indexation of these thresholds we've seen for a few years, and it will help if you've got the capacity to make the contributions to obviously better your retirement. And then the other change that came in last year was the removal of the work test to all contributions, which means that anyone up to age 75 can make contributions to super. If you are looking to claim a tax deduction for those contributions over the age of 67, you do need to meet the work test, which is the 40 hours in a 30-day period. If in doubt, talk to your BDO advisor. But the biggest thing in super at the moment is this Div 296 tax. Such a sexy name. Gotta love the government. So the $3 million threshold. We don't yet have legislation, so the BDO position is a little bit wait and see for the moment on this. We will obviously keep people appraised as we know what's going on. There were significant submissions made to the government at the time the exposure draft and draft legislation came out. They were considered and the government made very little change. We've subsequently had Senate hearings. Again, the industry made significant representation. Again, the position remains unchanged. So 15% tax will be applied on a portion of superannuation or earnings. That will include those unrealised gains, which is the sticking point for most of it, because that's the change in the tax system in Australia. It is only going to be on those earnings that are attributable to balances above $3 million and will start from 1 July 2026. That $3 million cap won't be indexed. It is a tax that will be levied to you as an individual, and then you can choose to pay it personally or from your superannuation fund. As I said, we don't yet have legislation on this. Keep an eye out for BDO super alerts. There's one coming tomorrow. We will try and keep you appraised as things happen. It has been debated yesterday in the Senate for the first time, and there was lots of, 12 voices of angst against this measure. So we still have to wait and see. I hate ending on such a negative note, Neil, but there's no bigger story in super at the moment than this one. So I'll hand back to you, but I think we're pretty much on time for today's session.
Perfect timing. Thank you, Shirley. Couple of observations I'll make. The Powerball jackpot tonight is 90 million. So if I win it, James, I will be retiring tomorrow. Couple of things that were mentioned. Increased funding the tax office was mentioned by a number of people, but no one gave the numbers. Just under $2 billion, and the revenue they expect to raise from that is just over $4.8 billion. So I wish I had investments that returned that sort of return. So it is massive what they are seeking to recover. What I would say is, if you're one of those people that haven't paid the right amount of tax, time to get your house in order, because you know, I expect there'll be greater scrutiny going forward. So no better time than to get things sorted. As a result of this, we're going to see more audit activity. Something that sort of slipped through, and it's a bit of a small one, but I find it interesting. If you're doing a transaction with a foreign resident, they cannot sign the transaction documentation until they get pre-approval from the tax office. I'm not talking about completion of the transaction. I'm saying they can't even sign the documentation. So once again, greater scrutiny and overview from the tax office. What's not in all of these numbers is the actual cost of compliance, which will be significant. Does that have an impact on executing transactions or the flow of capital? Hopefully not, but it will be a big number. And the one increase we're hoping we don't see is increase in inflation. Anders was probably a little bit more political than me, noting that there might be downward pressure before Christmas, and then people spend their $300 and upward pressure after that. I have a funny feeling I know when the federal budget, the federal election is going to land, but maybe I'm just too cynical. We have got a lot of questions. We have run out of time, so unfortunately we don't have time to address those. We will be sort of distributing something to address those. So I do apologise for running out of time and not being able to do that. But what I would like to do is thank all the people that presented today. I think it's been a really good session, and for a budget that has not much in it and is tinkering around the edges, there's still quite a lot of detail. So thank you, team, for going through that. For everyone online, we do appreciate feedback so that we can make these things better going forward. So please take a few minutes to provide feedback, and you will get links and information in an email after this. So please feel free to have a look at our website and have a look at all the information that's there on the budget. So thank you, everybody. Look forward to seeing you next time. Have a great day. Bye-bye.